Hey traders, Jason here from Lever Brothers. So this video is going to just serve as like a little bit of a reminder that big bounces are the norm in bear markets, and it's not wise to have a super strong opinion. Or I should say, it's okay to have an opinion, but have the ability to change your mind when new information becomes available. Okay, good traders have mental flexibility. If you're super bullish right now, okay, that's fine. Put a stop in place just in case the market has different ideas. If you're super bearish right now, that's just flat out stupid because the market's obviously acting very well. It's trending up. And if you're going to dig in and defend that position, then what if a bottom actually is in place? You know, what if it's in place? You're not only going to lose money on your shorts, but you are going to lose opportunity on some potential longs. So I'm going to go through the .com bubble era, the financial crisis, and then I'm going to show you charts from today just to show you what is typically what is normal during a bear market. All right, so let's go through it. So here's the S&P 500 covering 2000, 2001, 2, and the beginning of 3. And I just want to point these out. Here, after the market broke down, late 2000, we had a 10% bounce here, an 11% bounce here. This bounce got above its 50-day moving average. The 50-day moving average started to flatten out. Still dropped to a new low. Here's a 22% bounce. This time we got way above the 50-day moving average, so much so that the 50 actually started to curl up. Didn't matter. Market eventually rolled over. Here's a 25% bounce. Again, got above the 50, tested it over here. 50's trending up. You got a bounce over here. Didn't matter. Still trended down, lower highs, lower lows for a really long time. We have a 24% bounce here, a 24% bounce there. Okay, so even after, if the market topped over here, even when it had been down to here and down 35, 36, 37%, and then we got a 22% bounce that brought it above its 50-day moving average, which was then trending up, the market just simply proceeded to fall a lot more for another 2 years, okay? So it's a little reminder that big bounces are the norm, okay? And when they happen, go ahead and play it, take advantage of the opportunities, but just keep in the back of your mind that it's pretty normal to have big bounces within bear markets, and you just don't know which one is going to be the bottom, okay? Same time period, .com era. This is the NASDAQ. I'll go through it a little bit quickly. The market topped earlier that year and fell faster. So there's a 24% bounce. This is a 41% bounce. Okay, got above its 50, got above its 200. Both those moving averages were trending up. You could have made an argument that a bottom was in place, especially since the market had already dropped from there all the way down to here. Okay. Fell back down. This was a 21% bounce. You could have argued that, hey, a higher low is in place. We got the same highs here. We can break out and go out. Didn't matter. Went down. There's a 17% bounce. There's a 20% bounce. There's a 30% bounce. There's a 44% bounce. There's a 52% bounce. Even this little wiggle over here is a 21% bounce. And in each case, the market rolled over and dropped to a new low. Several of these, we have a move above the 50 there. We got a move above the 50 there, and the 50 starts flattening out. We got a big enough move above the 50 there that we get above the 50. The 50 starts trending up. We get a move above the 200. Didn't matter. Lost it. So you get the point. It's pretty normal to have big bounces within a bear market. If you're bullish, great. Play it, but realize that there's a possibility that it could roll over and give everything back. And if you're bearish, you're missing out on opportunities because if the market's going to bounce 20, 30, 40%, high beta names are going to rally 50, 60, 70, 100%. You're missing out on a lot. And of course, when the market actually does bottom, you're going to give back a ton of money. All right, let's go to the financial crisis. Here is 2007, 8, 9. Okay, so as the market broke down here in early 2008, you had a 10% bounce there. You had a 15% bounce there, which turned the 50-day moving average up. Didn't matter. You had a 10% bounce there, 19% bounce there, 28% bounce there. And in all cases, the market continued to go down. Then you get a nice bounce over here, but this bounce is no different than a couple of the other bounces that preceded it. You don't know if that's the low. Okay, so have an opinion, that's fine, but put a stop in place just in case your opinion isn't playing out. Here's the NASDAQ during the same time period. This is the financial crisis. NASDAQ broke down early 2008. We got a 10% bounce over there. You got 19% bounce over there. That gets above the 50. The 50 trends up for a couple months. Didn't matter. You got a 14% bounce there, 20% there, 29% there, and obviously a big bounce here that just kept going and going. You don't know which bounce is going to keep going and going. Okay, now let's go to today. So here's the S&P today. Market broke down early 2022. Got 9% bounce there, 13% bounce there. That takes it to a higher high. It's above its 50, which is starting to curl up over here. It's above its uptrending 200-day moving average. You could have made a strong point that the bottom was in. It wasn't. Market dropped. There's a 10% bounce there, 16% bounce there, 17% bounce there. We'll put in a higher low here, and now we're in a 12% bounce right there. Okay, we don't know what's going to happen. Okay, let's go look at the NASDAQ right now. All right, here's the NAS right now, 11% bounce there, 17% bounce there, 12% bounce there, 25% bounce there for the NASDAQ. Moves above its 50, 50 curls up, supports the stock there, curls up, trends up for several weeks. Didn't matter, the market rolled over and fell to a new low. 14% bounce there and a 20% bounce there. All right, so the point is, okay, within bear markets, it's normal to get big bounces. In all three of these cases, we had not only big bounces, but we had 7, 8, 9, 10 big bounces that went anywhere from 20 to 30 to 40 to 50%. And in all cases, the market still rolled over and made new lows. Okay, you have to have a little bit of a strong opinion in order to trade, because otherwise you're not going to have confidence to get in. But you have to have mental flexibility to change your mind when new information becomes available. Okay, that's what good traders do. You can have a strong opinion, that's fine, but when new information becomes available, you have to be able to change your mind, not dig in, not negotiate, not bargain, not argue your point. Okay, the market gets the say, and this is a game of follow the leader, and you're not the leader, you're the follower. You do what the market says. Okay, right now the market's moving up. It's great. Play the long side, take advantage of the opportunities. If a bottom's in place, you got some good entries for an uptrend that may last for several more months. But if a bottom's not in place, have stops in place just in case. Okay, it would be pure stupidity to argue that you're right and the market's wrong. Okay, big bounces are normal. One of the bounces are going to be the beginning of a bull market. You don't know which one it's going to be. Maintain some level of mental flexibility and don't argue with the market. Okay, this is the market is not a place for stubborn people. Okay, it's just not. You probably heard this saying, strong opinions weakly held. It's true. Have an opinion, that's fine, but don't argue with the market. Okay, don't be stubborn. Stubbornness gets you killed in this industry. All right, hope you got something out of this. I'll see you next time.